Okay, welcome everybody. As I say, my name is Karen Bransgrove. I'm the General Manager from the DIA. I'm really just here this morning to introduce Adam Ellis and Benjamin West, who are both experts on retirement side of things. They're from Prospero Wealth Management, and they're going to talk to you hopefully about some really useful things on retirement and what to look out for. Please post your questions in the chat box or in the Q&A box, and I will be monitoring those and asking questions at the end. So we will hopefully have a little bit of time, maybe 10-15 minutes, to answer some of those questions that come up. And of course, I'm here on the help desk or at the DIA should you want to call me independently for anything else afterwards. But in the meantime, I'll hand you both over to Adam and Benjamin, and enjoy the session.
Karen, thank you. Morning, everyone. Our aim today is to kind of do an overview of retirement planning. It's a subject which we could talk for hours on, but we're not going to do that today. We're going to try and go through this. We're going to try and explain some of the technicalities and try and break that down a tad. We always find the Q&A interesting, so please do pop some questions in so we can go through that towards the end. And then we'll also have there'll be a feedback form which will go out following this, where you'll be able to, if you want to register for future webinars. As an example, we've got one which is inevitably going to happen after the budget. And then also, if there's any areas on here that you'd like to follow up on as well, then it gives us the ability to kind of come to you and go through those. So what we'll do is just a very brief introduction on this. And when we talk about retirement planning, it isn't just pensions. Pensions obviously the mainstay of a lot of this, but we're a great believer in looking at income streams in retirement. And pensions obviously is one of those. One of the things that we always question is why plan for retirement, and of course things have changed. So if you go back some time ago now, you had a retirement age. Now, of course, there isn't such a thing, and a lot of pensions then had either a selected retirement age or a normal retirement date. And on that point is when you would normally retire, and you might have got to retirement at say 60 or 65. And what you would do would take tax-free cash if it was available. You'd probably take an annuity. If you had a final salary scheme or defined benefit scheme, you would kind of take the pension that was being offered by the scheme. And on annuities, there was no such thing as an enhanced annuity. An enhanced annuity is where you can essentially get more if life expectancy is less. And life expectancy then was mid to late 70s. That's according to the ONS. Now, of course, life expectancy is longer, and we have seen that increase over the years, and that we have to factor that longevity into our plans in terms of what we intend to do, because money might have to last longer, or if we want a certain level of income, we might have to build up more to get to that point. I remember going to presentation pre-COVID when you actually went and did these things in hotels and so on, and we had an actuary there, and the actuary at that point said they believe the first person to live to 200 is already on the planet. And the idea being there, of course, is people will health will change, and we might be able to, I don't know, implant a new type of ear or something. But the point is people are living longer, and I've got clients now which are very close to 100. One lady very recently nearly made 101. And there's always a good conversation around that, by the way, with state pension, because she nearly got 41 years worth of state pension, when of course, when it originally started out, it wouldn't pay out for that long. So longevity is a key thing. So where have we kind of got to with 2020 and onwards? So there's no such thing as a retirement age. Now, employers can't make people retire. Final salary schemes are pretty much gone. We have defined benefit schemes, and they may have changed how they do calculations or calculate the pension on their more career average and so on. But final salary schemes generally are no longer there. There's a huge amount of choice. I'm a huge believer in that the new pension rules we have now are brilliant if you know what you're doing, but dangerous if you don't, because you can make some mistakes which can be very costly, either in terms of tax or other things. Retirement can easily last 25 years or more. And as we said, we might need to consider other assets to provide for retirement. So just a very brief overview. We're going to try and go into some of the details. So pension freedom, when these rules came through, Benjamin's going to cover this a bit more detail later on. But essentially, when money comes out of pension, we have these options: annuity, drawdown, or flexi access drawdowns, it's now called, and UFPLS. UFPLS, by the way, any pension jargon, it's usually better or easier read if you basically read it backwards. So the LS is a lump sum, P is from pension, so it's a lump sum from the pension, and uncrystallised funds is pension terminology. Again, that's essentially money in a pension that we've not done stuff with yet. It's just built up, it's just there. So that's where we take a lump sum from the pension. So we've got annuity, flex excess drawdown, and UFPLS. As I say, Benjamin's going to cover that a little bit more detail later on. But just to, in theory, simple, but then this is a flow chart which can show how money can leave a pension scheme. This is from the 6th of April 2015. And of course, suddenly it no longer looks simple. And again, that's where we reiterate, these rules are brilliant if we know what we're doing. If not, and we go down the wrong avenue on one of these things, then we can cause ourselves some real tax problems. But before we get to the point of money coming out of a pension, we're going to work on accumulation, and this is building money up in a pension. So the first things we need to consider really is what we see on the screen. So how much income we're going to need when we retire. So what does that retirement look like? What do we intend to do? What would we like to do as well, as opposed to quite often when we talk to people about retirement, they almost start cutting things out. Whereas, of course, we'd like people to be able to do more, not cut things out. Then when we decide what we'd like to do and how much income we think that's going to need, we need to look at how we're going to generate that income. So where is that income actually going to come from? And there's a slide later on which will show, again, perhaps not just pension. What are the tax implications? So if we're going to generate the income, how are we going to generate the income in the most tax efficient way? And what do we need to do to build the pots with that in mind early? And then also, once we've built these pots and we're going to use them to generate income when we've retired, what happens if we then want to pass these pots on if we were to pass away, or if we decide we don't actually need all of this income or all of this money as we get older later on? Perhaps we start thinking or worrying about things like inheritance tax or care fees or all the various things. So we need to plan those pots in such a way that if we did decide to have flexibility to do something with those pots later on, we need to consider the tax implications of that. And then what we've got now, am I using what I've got now? Am I using my assets now to the greatest effect? So are we really making the most out of those assets now? Because quite often you can be saving into a pot and it might not be working as hard as it possibly could do, which of course means it won't be a big enough pot, which means it won't generate the most tax efficient income that we need later on as well. So we spend quite a bit of time essentially to start off with about thinking, what do we want this retirement to actually look like? And will that involve 5 holidays a year? Will it involve playing lots more golf? Will it involve whatever we want it to do? And we have a way of being able to then cash flow or write those costs down and then cash flow that through to a certain age. Now, we have a fantastic cash flow system, which we actually do. And I strongly encourage anyone who's planning for the retirement to kind of look at this type of thing. It's a way of visually trying to bring it to life as to what you're trying to achieve and to where you are. And you may be able to pop in there, I expect to, 4 holidays a year and play golf and all the stuff that we might want to do in retirement, and then look at how much that would cost on a monthly or an annual basis. Plug that into a cash flow system, which will show what these costs are later on. It will then take what we've built up so far, what we're building up to that point, and will we essentially have enough to be able to do what we're trying to do? If not, what do we need to do to be able to get there? And if we do have enough, perhaps what can I do to bring that forward? So rather than it being age 65, how if it was going to be age 63? Or how about if it's going to be age 60? And then also we can cover in there things you have to prepare that you might need to do before retirement. So give you an example, I've got a 14-year-old which might need money for a house deposit at some point. Now that might happen before I retire. So how will I generate that money to pay for a house deposit? Is there a tax efficient way I can do that, which won't affect my plan to retire at some point later on? And then another thing we often see, especially for those which are self-employed, I want to phase into retirement. I want to slow down and I want to cut the number of hours that I do. So what age can I start doing that? At what age will I have probably saved enough where I'll be able to slow down work and then start, if you like, turn the income tap on later on? Or moreover, what happens if I wanted to really cut the hours down and start using some of these retirement pots I've built up? Is there a way of generating an income from there to maybe cover, let's say I dropped 3 days worth of work, could I generate 3 days worth of work from my retirement pot, still work 2 days, so I still have the same net income, I still have the same money coming into the house, but that won't affect me later on, and I'll still be able to afford the gas bill when I'm 85 and so on. So the preparation thing is actually really quite important. The Benjamin and I often come across a lot of people that haven't really talked about that or thought too much about that. But what we have done is we've started saving into things. So we've taken that one step. Quite often it's, okay, so I've done this step. How far am I with this? And trying to bring it to life so we know where we are. Now, one thing we're going to cover in a moment is money going into pensions, money in there, and when money comes out. And there's quite a bit more detail on that. But what I'm going to do is just spend just a few minutes talking about this accumulation stage on retirement. So accumulation on pensions, and we're going to focus on pensions here, but this could be investments. This could be anything really, like an ISA or unit trust or anything which we intend to store money in, which we intend to then use for retirement later on. So when we look at accumulation, generally when people are paying into, especially for self-employed, when we're paying into pensions or we're paying into ISAs, when I say ISAs, I mean investment ISAs, not cash ISAs. When we're paying into investment ISAs or when we're paying into pensions, what we're then doing is putting money into a pot. Every time we pay and the taxman pays, and we'll cover the tax release in a little bit. But we're putting money into a pot, and when it goes into that pot, it then needs to be invested. When it's invested, it goes into certain investment funds. So we have essentially a choice in terms of where we want to invest those monies. More often than not, a pension scheme or an investment scheme will give you almost a default option. If you don't choose or quite know where to put the money, they will give you an option by default. You can pay it into this. Default funds generally aren't great, but there will be almost like a default option. But realistically, what we're trying to do is find the investment funds which will grow the most, make the pot as big as possible. And of course, the bigger the pot, either the earlier we're going to retire or the more fun we're going to have in retirement. But we need to focus on those funds because we need to make sure we're in good funds. One of the first things we would do when we meet someone new and they would give us the pension paperwork or the investment paperwork, one of the first things we do is actually we go straight to the funds and we're looking at the investment funds that person's invested in. The amount in that pot is actually secondary. The first thing we're checking is the investment funds. And the ultra basic reason why is if the funds aren't very good, then the pot simply won't be very good. Often you get a lot of press and talk about pay more in, pay more in, pay more in, pay more in. But you've heard the old saying, there's no point taking good money after bad. And if the funds aren't very good, well, why on earth would you want to keep paying lots of money into poorly performing funds? So one of the main things we focus on right at the outset is let's check the investment funds where the monies are going in. And we're checking those for performance because obviously we want high performing funds. And we're also checking them for risk level to make sure they're at a level where they'll move up and down that you're comfortable with, that you can sleep at night with. And so on. So on the accumulation part, when we're paying money into something, we need to make sure we have good funds. We actually operate, I might as well mention this. We actually operate a service, what we call initial findings, where so imagine I was speaking to Benjamin. Benjamin may have, I don't know, 3-4 pensions from different places from before, maybe an investment or something, and doesn't really know too much about it. Just knows I get statements once a year, and I have a look at it, and it might have gone up, and then I'll pop it in a folder, and I'll come back to it again next year. So what we can do, Benjamin would sign an authority letter. It's a letter which you sign to say we can go and gather information. But we can then pop an initial findings letter together, which shows you how much you've actually got in these pots, what's going into them. So essentially the numbers. There's a bit which shows a bit of blurb about each pension. So is there anything in there? Because some of the older pensions, if you take late 80s, early 90s, some of the old life companies, they had some guarantees built in. And what the charging structure. So some of the little bit of detail on the pension fund, and then really key a visual way of being able to see how it's performing. So we can see how it's making money, which one's the best, which one's making the most money, and do I therefore need to consider changing it. And quite often that's a very, very good starting point when you're preparing for retirement. What have I got? What's it invested in? What's the charging structure? Is there any guarantees on here? And then once we've kind of got that, you're able to start planning, well, what does that mean looking forward? So if I carried on with this trajectory, if I carried on paying in this amount, what am I going to build up in terms of a pot? And is that going to be enough for me able to achieve all these things I want to do at age 65? The other thing when we're in the accumulation stage is considering the other things that we could use for income later. So there may be two of us in the household. One of us may be self-employed, the other one may be employed, or the other one may have pensions from 20 years ago, or we may have pensions from 20 years ago. We could have some old defined benefit schemes in there, some old final salary schemes, and they will offer essentially two bits of information that we'd be looking at. So one would be what level of income have we built up in that scheme? So how much, if you like, final salary pension have we got? At what age will that be paid out to us? And what happens if I wanted to take it a bit earlier than what the pension scheme says I can? What would be the penalties, if you like, if I took that a bit earlier? They're technically called early retirement reductions, but they're seen as penalties. So if we had a scheme that says I'm going to get £5,000 at age 65, but what happens if I wanted to retire at 60? What would I actually get at that point? And then there's another thing that we consider on final salary schemes, which is these quite often offer transfer values. Now, transfer values are really low at the moment, having come from a period of about 3 or 4 years ago where transfer values were mega high. But again, that can be something we'd want to check because that can create a different style of retirement income than what a normal defined benefit scheme could do. So again, there's two things we'd be checking there. And then again, when we're looking at other things that we use for retirement, we may have investments. We may have built money up in savings accounts. And we've been lucky actually in the last year or two, we've had some reasonably decent interest rates on savings accounts. Now, interest rates have started to come back down again. So now we might be thinking, well, the money we've built up in savings, is it in the appropriate place when we're in this accumulation phase of building money up? Is it in the appropriate place for the next, say, 3, 5, 10 years, or however long till we retire? And should we maybe consider moving that pot into something else? So the accumulation phase very often is preparing, thinking about what we want it to look like later on, understanding what we've got now. Are we on track? Are we anywhere near? Are we ahead? And then where have we got these pots of money? Are they working as hard as they possibly can? Or have we just ended up in an investment fund or pension fund where it's just been left in the same fund for the last 10 years and it's never really changed? And then we keep checking it. And that type of plan realistically should be checked every year or two just to make sure it's on track and it's working. From experience, this is the grey hair experience here, having done this job for over 20 years now. Those that plan achieve what they're trying to get at the end of it. Those that don't plan, and very often we come across people with a year to go to retirement or 2 years to go to retirement, which we are at that point, so we're helping at that point. But they may not be achieving what they wanted to achieve because they simply didn't know how far down the track they were. So let's move on to another bit of pension terminology. So we're going to talk about annual allowance and how this works. There is a slide a little later on about tax reliefs, but I'm going to try and incorporate that in onto this slide, or I might actually, you know what, I might jump ahead. Let's jump ahead 4 slides. Right, so we're focusing on pensions here now. So why do we pay into a pension? I'm going to assume from a self-employed stance here. So we may be trading through either a sole trader or a limited company. So for a sole trader, essentially the direct debit or the amount that's being paid into the pension perhaps is just coming from our personal bank account. We may have got an account set up to one side for business purposes, or we may be trading as a limited company. And if we're paying into a pension, the money would come from a limited company. So let's cover both of those scenarios. If we're employed, now this may not affect too many on the call, but it may affect a partner, a spouse, a child, a parent. Generally on employed, really, really simple. You pay in, employer pays in, taxman pays in. That's basically how that works. The one thing we'd always encourage is people, if they can afford it, to go to the highest level of matching. So if they pay another 1% and if we match it, then great, we take advantage of that. But let's focus on this bit. This is self-employed sole trader. So what we're going to work on here, if we just work at the bottom, we'll work on basic rate taxpayer. So basic rate taxpayer, just for how the income tax systems work, with any profits or income, if you like, from 0 to 12,570, no income tax payable. Interestingly, though, still get income tax relief on pension. A basic rate taxpayer is for profits between 12,570 and 50,270, so between 12.5 and 50,000 for easy numbers. A high rate taxpayer goes from 50,000 or 5270 up to 100 grand. There's a quirk at 100 to 125. And if there's anyone on the call whose income, whose profits are between 100 and 125,000, or has a partner or someone who has income at that level and doesn't understand how you can use pension contributions to attack that tax thing, because between 100 and 125,000 income, the effective income tax rate is 60%, and then there's national insurance on top. Pensions can eliminate that. Big key thing you should know if anyone's on there. And again, that could be something you could follow up with. But focusing on the basic rate taxpayer. So if we had money coming out of the bank account, why would we pay into a pension? The simple reason is the tax relief. So to get £100 into the pension, £80 would come from the bank account. Effectively, the government, if you like, via tax relief, adds 20, so £100 hits the pension. And there's only really, the lifetime ISA does an element of that type of thing, but it's a different thing, really. There's not many other accounts out there that I know of where if you put £80 into something, the government's going to add money into that as well. Now, with a higher rate taxpayer, to get £100 into a pension only costs you 60. Now, there's a quirk in terms of how that's done, but essentially a higher rate taxpayer will obtain more tax relief. Now, it's worth spending 2 quick seconds on this. So a basic rate taxpayer, £100 into a pension costs 80, as it shows on the screen. For tax reliefs, money going into a pension, if we're under 75, you can get tax reliefs going into a pension. You don't necessarily have to have any income either. So we have got scenarios with people that we look after where we may have one person who's out working, generating profits or employment income, and another person that perhaps isn't, and therefore isn't paying into a pension. But of course, they're still at the accumulation stage of building monies up for retirement at some point. Every human, if you like, who's under 75 has the ability to have £3,600 a year paid into a pension, and it only costs 2,880, which I know is a weird number, but essentially 2,880 could be paid into a pension for someone who has no income whatsoever, and the government would put in the £720, and they still get £3,600 that hits the pension. Now, if you consider they're getting tax relief when they haven't paid any tax, that's actually quite interesting. We'll come on to how that can impact, or how it can work with children as well. So why do we pay into a pension? The tax release. Every time we pay in, taxman pays in. If we're a high rate taxpayer, very generous. It's also now worth spending 2 quick seconds on pre-budget planning. So Benjamin and I, with someone else, did a pre-budget planning webinar. I forget when it was, either beginning of this week or last week. And there's a huge amount of press speculation around pensions at the moment, which there always is before budget. It's just this time around, it's 2 months before the budget rather than 2 weeks before the budget. But one of the things we were talking through on the pre-budget planning in terms of what should we consider doing before the budget. And for higher rate taxpayers, so that's if we have profits or total income as well, don't forget, if it's income over 50,270, we have a huge amount of clients at the moment paying lump sums into pensions, grabbing the tax relief while it's there. Because if we drift into the budget and the tax relief were to fall, then we might get less of this every time I pay in, the government pays it. So grabbing the release while we are now, if we pop a lump sum of money into the pension now, we get the tax relief now, we secure that tax relief. If I was going to pay a lump sum into a pension, I was going to do that, for example, in January, it might be sensible to do it before the budget. There's been reasonable speculation about a flat rate 30% tax relief, which means a basic rate taxpayer or even a nil rate taxpayer could in theory get more tax relief. It could go up to 30%. So there's an argument therefore for basic rate taxpayers not to charge ahead and plough monies into pension as quick as possible, but there is a very good argument for higher rate taxpayer to do that if you're taking a more prudent approach. But for a non-earner or children, which we'll talk about in a few minutes, if you've got no income tax that you're paying, yet you still get income tax relief on a pension, that feels perhaps a little out of kilter. So perhaps that could be looked at. So if we're a non-earner, or even we're considering child's pensions, that might be something we'd want to get done before the budget. Because one of the main reasons we're talking about here is why paying to a pension, it's a tax relief. Every time we pay in, the taxman pays. Right, let's just jump back a couple of slides. So let's go back to the annual allowance. So the annual allowance, we have this generous regime of every time we pay into a pension, the taxman pays in, so that's good. But of course, there's amounts that we can pay and there's limits that we can pay into this. We can't just plough every pound we have into a pension. To put simply, the most we can pay into a pension is up to what we earn. But there's also a cap on that amount as well. So on the right-hand side, this jug of blue water gives the allowances where we are at the moment. So in theory, we can pay £60,000 into a pension. So when it says £60,000, that's the amount that hits the pension. So that's us plus a taxman paying in. We have to have the income, or what's called the relevant earnings, to be able to do that. So relevant earnings, for example, are self-employed profits. They are wages, rental income doesn't count, savings interest doesn't count, dividend income doesn't count. But in theory, we can pay in £60,000. The £10,000 is a quirk in the system. It's something called the money purchase annual allowance. That's if someone has taken money out of a pension from the taxable part and not the tax-free bit, if they've effectively flexibly accessed a pension, but that's not a thing for today. So in theory, we could pay £60,000 into a pension. And then what we're also able to do is if we have the earnings to do it, because remember, we can only pay up to the earnings level. So let's say we had £100,000 profit or relevant earnings. We could use this year's 60,000 allowance. We can then actually look back 3 years and we can see if there's any allowances we didn't use in the previous 3 years and carry them forward onto this year to allow us to pay more than the 60,000 and perhaps up to the 100,000. And we have had that happen quite often when we have higher earners who didn't really understand the tax allowances, the tax breaks on pensions. And then okay, I get this now. I didn't realize this from previous years. I now want to try and catch up with some years. Is that possible? And yes, we can go back. We can go back 3 years. This, what we call a carry forward calculation, it's quite complicated in some ways to do, but this is something that we're quite able to do. And again, if this is one of these things that you would like us to follow up on, then just let us know, and that's something we'll be able to help you with. A brief 5 seconds on lifetime allowance. This was essentially a tax charge on an amount of money in a pension once we kind of use the word crystallized and so on. But essentially, you had to over 1,073,000 in a pension before it became a bit of a problem. That was abolished a little while ago. It took about a year or so to go through. Labour so far said they have no plans to return lifetime allowance. It was actually replaced with other rules. But again, that's not really a thing for today. I'm going to spend just a quick moment on children's pensions, and then Benjamin's just going to go through the extraction method, if you like, and how we take money out of a pension. So children's pension, the reason I like to cover this is more often than not, we generally find people don't know it exists. So it's really quite one of these little tricks of the trade to know. Both, I've got a 14-year-old and a 10-year-old, both my children have had pensions since they were 3 months old. Basically, as soon as I got a birth certificate, I set one up. You're able to pay in, that's the 3,600 thing that we talked about earlier. So we can put in 2,880, the government would put in 720, 3,600 would go into the pension, but we actually do children's pensions from £20 a month upwards. So if you put in 20, the government puts in a fiver, £25 hits the pension. It can be set up, well, it's got to be set up by the parental legal guardian, but anyone can pay in. And the reason I mention that is often you find grandparents really like paying into grandchildren's pensions because they get it, they're on pension, so they understand the importance, they want to help set the grandchildren up. And also parents might be paying into their own pensions, might not have the ability to pay into the grandchildren's pension. So the accumulation stage on pension can actually start pretty much from the day you get a birth certificate. It doesn't have to be when I start work at all. But of course, any money that goes into a pension, we can't access it until age 57. At the moment, it's age 55. But from 2028, that age when we can access a pension goes up to age 57. Now, I've just got to quickly cover this. I've just remembered I didn't talk about corporation tax relief. I tell you what, Benjamin, do you want to do that? Money going into a pension, corporation tax relief. Do you want to do that?
Yeah, I'll try and keep it quick. So all of the conversation so far has assumed if you're a sole trader and getting tax relief via income tax relief, so obviously tax return and that side of things. Now, if you're a limited company, so you earn your money paid into the limited company, then you distribute the funds via salary or dividend, or maybe you don't, and it just sits in the company because maybe we don't need that money. There is a rule around at the moment which is really good, and especially pre-budget, it works really, really well. Is that if you're a director of your own limited company, then obviously you're in control of how you get paid. So you can choose, I want a salary, I want a dividend, I want to have potentially my partner as a director on as well, or I have business partners, and we will then sit down and we decide around the coffee table, I deserve a pay rise this year. This is how I'm going to pay myself. Now, one of the benefits of being a director of that company is obviously you would potentially choose to take a salary and some dividends because that's a really tax efficient way of withdrawing your income. And one of the things that we see quite often is people have all of this set up and don't know that as a director, you can also withdraw money from limited company account, so in a taxable environment, into your personal pension. So there are a few things that need to be ticked off to make sure HMRC are happy. But the long and short of it is if you take a nominal figure, so £100 comes out of that limited company and gets made as a director's pension payment to your personal pension, then you'd save at least £19. So corporation tax, because again, pending the accountants agreeing, and that's something we would check and can check for a lot of clients, is that's an expense for the company. So it goes against your profits. So the tax that you pay within the company is reducing, plus you're getting money into this pension, which can then build up for future generations, and to get you retired a bit more quickly. And it's essentially, it's a tax-free benefit at the time of making that contribution. So if you are in that situation, you haven't heard of this before, for a reason we're not going to go into now because we don't have loads of time, the government might be changing things in 3 weeks' time. So it's really, really, really worthwhile having a look at that quite quickly.
Yeah, employer NI on pension contributions has been an interesting little thing for the last week or two, hasn't it? when we talk about building a retirement portfolio, these are what we call the building blocks, almost the different things that we would take into account. And again, we would build this into cash flow planning. That cash flow planning is really useful visually in terms of seeing where we are. But of course, a lot of people tend to forget about state pension because it feels like it's so far away. And arguably it could go back as well. There was a white paper a little while ago about moving it back 1 year in every 5, which I think I calculated mine to be about age 74. But state pension is actually part of the retirement thing. When we do cash flow planning, we age people up to 100. So a lot of that time we will have state pension. It's always useful to obtain and understand where we are with state pension. There was a bit, Martin Lewis, I think, did something on a TV program a while ago about buying back years on state pension. And the state pension helpline really struggled to cope with the level of inquiries after that. But that shows it's worthwhile checking on this type of thing. We can show you how to obtain a state pension quote really easily, and then how it works with that. But state pensions, that is effectively an income which will be index linked at a period of time later on. And if there's two of us, we're talking almost £1,000 a month each on state pension if we get that right.
Adam, sorry to jump in on that, but a really important point on state pension. There's a couple of months left where you can carry back and buy years. So that time frame, that window is closing in, I think, in a few months' time. So if you're someone who has been a sole trader historically or even now, and you're not sure if you've made the relevant contributions for years of pension, then it might be £100 or £150 to buy a year today, whereas in 7 months' time it could cost you £800 or £900. So checking costs you 10 minutes of your time and a bit of faff trying to remember your government gateway ID and everything you need to get in there. But it could save you thousands of pounds both now and when you tip into state pension age.
We have got a little bit of a help guide, almost like screenshots, click here, press this, do that, and then send us a result and we can talk you through it. So we have got that. So Benjamin's just going to talk through now briefly on annuities, drawdown, and UFPLS, and then also we're going to talk about pension death benefits, and then we're going to dive into questions. There's a couple of questions in there at the moment, so while we're going through this, a good opportunity to type in some questions if you have some as well.
Yeah, and sorry, Phil, I can see yours in there about drawdown versus annuity, which is best. So that's a massive, it depends. So it might be worth a further conversation on that, on your situation. But so to take a bit of a high level approach to it, it's useful to know what happened before and what's changed. So Adam had that slide which said pension freedom, nice and simple, 3 choices. And then these are all the complications with if you make choice 1, then choice 2, then choice 3, etc., etc., etc. So to distill it, before 2015, you essentially had 2 choices. So you had your retirement age and you got to choose, do I retire now or do I retire later? You would then take some money as a tax-free lump sum, and then you'd buy something called an annuity in some way, shape or form. Now, the annuity is somewhat like a state pension. So it's a guaranteed income for life, but you purchase it from your pension fund. So a lot of people have heard of those. Essentially, you pay money into a pension, and then on a set date in the future, and depending on your age, your gender, your health, your postcode as well, actually, which is an interesting consideration, an insurance company will tell you how much money you would be given in retirement. Then that starts from the day that you click yes, you click accept, and they agree, and that will continue for the rest of your life. Now, there are a few things you can do with those annuities. So you can make them increase, you can have them level, you can broadly tinker with the terms as you can with most things. If that's of use and if that's interesting, so that where that normally comes in for clients is if I don't want to have to take any investment risk or I need to know my fixed costs are covered, then an annuity will do that. So whether Donald Trump is in or whether Elon Musk is tweeting, or sorry, it's X these days, isn't it? But that takes out any form of risk in your retirement planning. But sometimes it's quite poor value, although we are now finding ourselves in an interesting situation where annuity rates are almost historically high. So if you're looking to do that, now is a good time to as Adam said earlier, check what you have, what that could be the equivalent of in terms of an income moving forwards. Now, I realise I'm hammering the point about annuities, but really important that that's the reason, sorry, that's the route that everyone used to take, because that's how investment funds were set up. So pre-2015, everyone would buy an annuity. Now, that meant that big investment houses with these default investment funds, so you pay into a historical workplace pension, and this fund would sometimes have a date on it. So some of you might have an annuity drawdown pension pot that says date 2026 on it. Now, that says in that pension fund's mind, you're going to be retiring in 2026 and you're taking an annuity. And that's all well and good. So what that encompasses is something called lifestyling, which in theory is moving you from higher risk things towards lower risk things the closer you get to that 2026 date. Now, in reality, what that's doing is moving you from company type shares to investment bonds, which again, just a jargon thing around what the government can generate. Now, that was all well and good until Kwasi Kwarteng and Liz Truss stood up 2 years ago, and we saw a lot of clients, or a lot of people who came to us after that, lost quite a lot of money because they managed to reduce the value of all these low risk investments. So I realize it's not a withdrawal technique, but knowing whether you're in one of these lifestyle things, whether your current pension plans for you to take an annuity, a drawdown, a UFPLS thing is really important, because that can actually affect how much your money is going to move or how much income you would get, even if it's a couple of days before you plan to retire. So that being said, the majority of people now that we work with, I'd say probably 80%, are combining a combination of these three options. So if an annuity is a guaranteed income, you've then got the other two options, which is this flexi access drawdown. So I'm sure everyone's heard someone mention, I'm going to start drawing down my pension. And then this UFPLS thing, which, as Adam said earlier, is better read backwards. So if we start with drawdown, and I won't keep it too long. So within the pension pot, under current rules, you should have 25% of your pot is tax-free and 75% is taxable. What a drawdown allows you to do, or a flexi access drawdown, I should say, is essentially split those parts. So if we take the example of someone who is slowing down a bit, so I want to work 3 days a week, I'm still going to have an income, so I don't really want to take loads of money for my pension if I don't have to, because it's going to get taxed a lot. So a drawdown allows you to take bits from the tax-free part. So it's almost like turning on an income tap. So you can say, I want £100 a month from the tax-free part of my pension to supplement the income that I'm already receiving, and it doesn't cost me any tax. So that's a really good flexible option. You can also increase that, decrease that, and historically a lot of people talked about taking their 25% as a lump sum. Seeing less of that now, because you don't have to. So if you can leave that in and keep that paying a tax-free income for a longer time, then combined with any of the other things we've spoken about, that's a good strategy for potentially getting you beyond 100. Because obviously with taking money from the pension, the worry is, well, what's enough and what's too much? I don't want to run out of money by the time I get to 65, because then I've got a couple of years between that and the state pension that I'm either going to have to go back to work, which we don't want to do, or find some other sources thing. So then moving on from that drawdown option, we've got this UFPLS thing. So this is more of a lump sum option. Now, where this one works, to give you an example, is so if I'm a few years from now, I decide, right, I'm stopping at 60, and I think I need £12,000-ish or £15,000 a year to live. I don't have any income between 60 and my state pension age kicking in, but I do have this pension pot. Part of it's taxable and part of it's tax-free. And I'd like to use, as I'm sure a lot of you will be able to appreciate, tax allowances. I'd like to use my personal allowance. So using this UFPLS thing, so lump sums from pension fund, which are part taxable and part tax-free, I would be able to draw some money from my pension from technically the taxable part, but I would pay zero income tax on that. So it becomes quite an interesting strategy of meshing the three options together to find the right route for one per se. So I hope that makes sense in terms of the different routes and how they work. The last thing I'd say on that is they are very complicated, and either running out of money or not having enough money to live are really real issues. So if it is a drawdown or an annuity best, I would speak to someone and find out the ins and the outs of what's going on within your personal pension fund to decide which route you should take. Now, the fourth route of, and unfortunately, the fourth route of money coming out of your pension pot is if you're not here. So, for example, if I walked out today and went under a bus, then what happens to my pension pot? What are the rules? So 75 at the moment is a bit of a line in the sand for pension pots. So before 75, your pension pot would be inheritance tax free, which is massive. Really, really big, by the way. If we look at what's going on with the budget and property prices and more people paying inheritance tax now than ever before. So pension inheritance tax free. And then if you're, again, before 75, then there's no income tax for your beneficiaries to pay. So another way of looking at it is your pension pot is like a second life insurance policy that can be paid out to whoever you choose. Now, after 75, the rules change slightly. It's still inheritance tax free, but there might be a bit of income tax for the people who receive that pension pot. Now, this is one of the biggest half jobs we see. So every pension should have, and I can see Adam nodding away in the background there. So for these initial findings, things where we get out the terms and conditions and help people understand what they have, the biggest half job we see is the nomination of beneficiaries. So the rules changed 2 years or so ago now, where a whole load of different tax things came in, which were really good, but it also meant that you need to have nominated people in order to maintain some of the favourable tax statuses of your pension. And that's all well and good, because a lot of people have. If you haven't, please, 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 let's get that going pretty soon, because that's massive. But also being able to leave part of this pension or bits of the pension into a trust has become quite relevant these days. It doesn't necessarily have to cost you a great deal of time, and there's nothing you can do once it's happened. But for all of our clients, we would have the nominated beneficiaries, and then we would have a pension trust set up. Now, what that trust does, I realise that's everyone gets a bit complicated. Oh, what's a trust? What does that mean? All it does is it allows your pension to be paid into a thing which can protect your children or your beneficiaries. So with partners or divorces or potential issues around means testing in the future, this ring fences your pension pot away from those potential issues, and is something that you should definitely consider if you haven't looked at already. Have I missed anything there, Adam? Because I know it's the whirlwind of pension death benefits. You're on mute.
No, essentially, no. The main thing is always just checking what we always see. The pension death benefit forms are generally an expression of wish. I leave money to and they don't have all the other options on there. So as we say, half a job on that. We don't have a trust built in. We don't have all the nominations for dependents, flex, extra, and blah blah blah. So it's almost the old thing of, I have a will. I get a will checked every few years. Essentially, it should be the same thing with pension death benefit forms. That's a very brief whirlwind, as we say, overview of retirement planning. There's some questions in the question and answer section.
Shall I take one? Shall I take the anonymous attendee with the retirement income plan at 60?
Go for it.
Yeah. So it says anonymous attendee. So if I keep my self-employed status and take previous career retirement income at 60 as a lump sum plus take monthly payments, will I have to pay tax on any part of the income? Potentially, yes. Now, what we were talking about earlier with the lifetime allowance issues that Adam spoke about, that becomes really interesting for you. So you would likely, depending on the pension, if it's an age 61, that would most probably have been from before 2000. So you might have a choice as to what you do in terms of taking a lump sum or not. So that's a really big choice, potentially bigger than it appears at the outset, and that's a really big choice that you should look to maybe think of making this year. So you would technically, if you took the lump sum, that should be tax free. The income may be taxable depending where it sits in your tax bracket. But if you want to chat it through, I'm sure we'd be happy to have a look at that and give you the exact numbers.
Yeah, I'm guessing because we have a set age on this, there's an assumption here that the scheme pays the pension at this age as opposed to I've decided at this age to take the income. If it's income from the pension scheme, then the income is taxable, but whether we'd pay tax or not is totally correct. It depends on the other income. It also depends on how we're taking that self-employed income, because if we're taking the self-employed income, and it is self-employed through sole trader, if you like, as opposed to trading through a limited company. Don't forget, of course, limited company, we can control our earnings in some way. The other bit, which I would definitely be checking on, and often this isn't shown on retirement forms, again, is what's the cash equivalent transfer value on that, and what is this transfer value, and what does that mean, and how does that impact my personal situation as well. More often than not, we tend to see, we get retirement forms from a pension scheme, and option A, you can have an income of this without any tax-free cash. Option B is a low income with a chunk of tax-free cash. Sometimes there's an option C where I can go somewhere in between, but we very rarely see or people understand about option, let's say option D, where there's this transfer value. What on earth is that? Where do I go with that? And Benjamin's right. Once you make the decision on this, that's it. You cannot go back. It's one of the biggest decisions we make. We need to make sure it's right. Alison, you popped a really good question on there. Gone self-employed, previous pensions set up as limited. What should I do with my pension moving forward? Should I continue with Scottish Widows or start again? So that goes back to what we were talking about earlier with the accumulation stage. So the first thing we double check on is the Scottish Widows pension and what investment funds it's in. It's possible if it's an old Scottish Widows pension, you may well be in something, for example, like the old mixed fund. They updated those pension portfolios in recent years. But what we do is check on that fund. And if that fund is the best fund around, it's perfect, it's making lots of money, then of course we'd pay into that one. If it isn't, then as you popped in there, we'd start again. But then we'd also consider the money that we built up in Scottish Widows. If we found out it's not the best, we may want to move that into something that's better, especially if we've had that for a number of years, because we've probably built up quite an amount in there. That's where that initial findings thing we were talking about earlier is really key. Because if you're not careful on that accumulation stage of pension, we can almost end up in this position where we've paid into something and we've just left it, we've left it. It's almost kind of cross fingers, it pans out later on, which of course isn't the best way. So what we do is double check on that pension. And if it's great, yes, we pay more in. And yes, it comes from the company. And we can just remind you how the tax breaks work on that with a saving against corporation tax, assuming all the things tick into gear for that. And if it's not, then fine, we would sort out another one. There's a question at the beginning. I know, Benjamin, you covered about drawdown annuity, which is best. I think it's also a combination of both on that. So which is best? It's what suits the person. You talked about we haven't done annuities for many a moon because the annuity rates were so low. And nobody really wanted, there was no perception really of value for money. Annuity rates went up, suddenly they became quite interesting. You can actually buy annuities with savings as well. And if we have health issues, then enhanced annuities become really interesting. And you can even put on there things like capital protection. So there's things on there which means money can pass on as well. But I tend to find drawdown annuity almost direct opposites. So one might be giving us death benefits, the other might not. One might be giving us guaranteed income, the other one might not. One might be interested in share markets, the other one might not. So that's a conversation really depending on what you're trying to achieve with that. And then Pam, I might throw one of these questions at you, Benjamin. So on the pension, if we take a pension, do we have to take the tax-free lump sum first? And then we'll cover the second part of the question after. So do you have to take all of the, let's say, do you have to take all the tax-free lump sum first?
No.
Okay, thank you for that. So let's put a little bit more context around that.
No, so you've got options with the tax-free lump sum. Historically, it's always been called a lump sum, hasn't it? So I guess that's the idea of I have to take that. So no, nominally, if there's £100 in the pension, then you've got a choice of what you do with that 25. So you can leave it, you can take £1, you can take 50p, you can take £1 a month. You have a choice of either taking it as one big lump sum, a series of small lump sums, or as an income and taking it out every month if you so choose. Now, sometimes you're limited with the pension provider. I know, for example, some Aviva plans just don't allow you to do a regular income. So that's where a lot of people think that they have to take the lump sum, because pension providers sometimes don't allow you to have the full flexibility in how you withdraw that tax-free bit.
Yeah. So I always kind of refer to it like the tax-free part of the pension. You can just keep drawing down on that until you've essentially kind of taken the monies from it. The other question was on there: can we pay tax on the drawdown so we don't have to pay tax later? You can't effectively elect to pay the income tax up front on that, but you can get really clever with drawdown in terms of how you create income, depending on the other income streams as well. So whether we can use up personal allowances, we consider things like marriage allowance and so on, and are we able to essentially use up an allowance on a pension and use personal allowance if we can take from a taxable part of the pension and not pay tax, and that's an allowance we've got to consider, or we should consider using. The question about state pension. So we're able to send the thing through with the screenshots and so on how to do it. It's important we check that. So David, you're right, it's important we check it, but it's also, once we've checked it, what do we do with that information? And what does that mean for the overall retirement plan? As opposed to, okay, so we have a state pension, we have a figure, we know what we might get at a certain age, because don't forget, of course, there's no guarantee on state pension. And then what does that mean for our overall retirement plan? Which is a really key thing when we're planning out what we want this to look like. I can't see that we have any other questions in there, but we will, as I say, send out this feedback form, so there'll be opportunity there to ask more if you would like to. Karen.
Adam, I just thought I'd come in at that point. I've got a question myself.
Go for it.
So I thought I'd sort of put that to you. Being sort of coming up to sort of thinking about planning myself, what's the best way for driving instructors or self-employed to sort of manage their payments monthly? Because it can be very intermittent in terms of how much we wake from one month to the next. So do you have any recommendations for instructors on how they can save regularly and effectively?
Yeah, it's cash flow. So we deal with a huge amount of people that own and run businesses in whatever form, but generally cash flow is a key thing for anyone who's running a business. So if we're self-employed, if we're a one-person business sole trader, or if we employ thousands of people, cash flow is generally the main thing. So what we found the best way for doing this is generally to have a direct debit, a monthly payment that goes into the pension that we know we can cover, and we don't have to worry about, can we afford to eat next week or anything along those lines. So that might be a relatively low amount, but that's fine, because what you have is continuity. So don't forget, if I put £100, let's use a £100 example, it's a little different to earlier, but if I put 100, the government puts in 25, that's assuming we're a basic rate taxpayer. That's actually what would happen. We get the high rate relief on the self-assessment later, but essentially, let's say 100, the government puts in 25. So we know that's happening. That's ticking away in the background. That's going on. The amount is whatever someone feels comfortable with. Don't go too high, and then we're worried about cash flow. And then, if we're a sole trader, it's different if we're a limited company, but if we're a sole trader, as we get towards the end of the tax year, so we generally do a lot of this kind of looking around, if you like, in March. We don't want to leave it till the last second. You'll be amazed how many do, but we don't leave it till the last second. What have we built up in money that we know we don't need? And let's say it might have built up 1,000, 2,000, 5,000, 10,000. Okay, we don't need that. We'll now top up the pension with a lump sum of money, because at that point, we know from a cash flow point of view, we don't need it. So now we can pop it into the pension. And of course, the closer we get to age 55, it changes to 57 in 2028. But the closer we get to the age where we can access the pension, that risk of locking it away, if you like, in a pension diminishes. So if we've got, we generally find people in the late 40s or early 50s really start hitting the pension hard, because it's not that long till I'm 55, so I can always get it back out again. If I've got it all wrong, I can always get it back out via the tax-free cash as well. So the strategy usually is a direct debit that's affordable and top up towards the end of the tax year. If it's a limited company, same game, but the timing of when we put up a lump sum is to do with a trading year.
Okay, that's really useful. Thank you. So thank you very much. It's really interesting, really informative. Thank you. I'm sure there will be some questions from people later. They're more than welcome to pop an email through to me, which I can forward on, or come back to you directly. And just really at the end of today, just really wanted to mention that our conference is coming up, our DIA conference on the 6th of December. That's on a Friday, and hopefully you'll both be able to join us as well to meet some of our members in person and answer any questions. But feel free to go to driving.org to book a ticket if you haven't already done so. But thank you very much to everyone, and you know, I wish you all the best.
Thank you. Thank you, everyone.
All right. Thank you. Thank you very much. Bye-bye.